we don't have a CPA, Certified Public Accountant, next, but we do have a CFP next. And that would be Tony Drake, who is the owner of Drake & Associates. He is a certified financial planner, founder of the Drake & Associates, and born and raised in Milwaukee, Wisconsin. Wonder if he's a cheesehead. Can you be a cheesehead and be from Milwaukee?
I think so, yeah. You can... I think cheeseheads are welcome anywhere in Wisconsin.
Really? Oh, that's cool. Well, Tony's an investment advisor representative and is licensed to manage money. He has 10 years or over 10 years experience in the financial industry, and he served clients from all over Wisconsin and specializes in asset protection and retirement planning. And in addition to serving, he trains and mentors other financial professionals all over the country. He has also made appearances on Fox, Wall Street Journal, Yahoo Finance, a litany of others, and now he makes his appearance here at Unlock Your Wealth Radio. Tony, welcome to the show. We are thrilled to have you a part of Unlock Your Wealth Radio.
Thank you so much for having me, Heather. I'm excited.
I am too, because it's been a long time since we've talked about risk. And, last year we saw some peaks in the stock market. And, I think about when I was a financial advisor many moons ago. And one of the things that folks didn't understand, or their advisors weren't sufficiently motivated to have the customer's best interest at heart, and they had their own commission-minded interest at heart, was risk tolerance. And, we defined that word in our Moolah Word of the Day segment, but what really is risk for an individual?
Yeah, I think you pose a great question, Heather, and it's something a lot of people, I think, just aren't spending enough time analyzing. I think you nailed it on the head. Unfortunately, in our industry, sometimes, not everyone, of course, but folks are driven by commissions. I think it's really important to be aware of how you're paying your financial expert so you can really analyze, is this advice in my best interest or theirs? But the missing piece that we see is that conversation about risk. So many folks in my industry have a great hot investment, a great portfolio. They want to brag about average rates of return, and sometimes I think that missing component is how much risk are you comfortable with? And really not a whole lot of right or wrong answers there. There's some basic guidelines we can certainly follow based on your age and kind of things that you're shooting for goal-wise. But that's an important conversation to have, because when the market corrects, and we know it will, we're all hearing day after day, new high, new high, new high. We know it's going to correct at some point. None of us really know when that's going to happen, but it will happen at some point. What's that pressure point? What's that point where you say, I've lost enough, and then you end up selling at a low, which is the last thing we want to do.
Right. Well, I look at market corrections as like discount shopping. Hello.
That's right. That's right.
It's half off today. Let's go shopping.
And I think that's a wonderful attitude, especially for people that can afford that time horizon. So it really becomes a question of time, right? I mean, we work with a lot of retirees, and the one thing I think we give up as we approach retirement or enter retirement is that luxury of time. So if we have the time to let that market swing, there's nothing wrong with it. You can buy things at a discount, just like you said, big sale on some great value companies, but you have to be willing to wait that time out to let them come back, right?
Right. Well, here's a question for you. And since you're the Ask the Expert, I thought I'd ask the expert. If we already know to buy low and sell high, why don't we?
It's a really interesting concept. And there's actually some investors, believe it or not, that'll follow retail trends. So when we look at a retail investor, that's maybe somebody who's out there doing it on their own, kind of going for it, making some great hot picks. And statistically or historically, I guess, retail investors tend in general, when the market's starting to do really well and things are getting to a real high point, they get excited and they start to buy for the first time because their confidence rises. And then, of course, the market begins to correct and they start to panic, and then they'll sell off when things are low. And I think people lose sight of that long-term horizon. I mean, sometimes the best thing to do is to absolutely flush something out of your portfolio. There are sometimes some losers that you don't want to hold on to, but that typical retail investor, some folks will follow those trends. And when they see retail investors coming into the market heavily, they'll say, boy, it's time for me to sell and get out, and vice versa when they're starting to sell off. That, is a buying sign for a lot of folks.
Well, and I always think, it's okay to take a profit. Even if you like the stock, you may want to take your profit and then get back in when the market corrects and just kind of cash out.
Yeah. I think anytime you're locking in a profit, there's certainly nothing wrong with that. And that, I think that greed factor comes in for a lot of us. And, there's some interesting studies lately where kind of the title of the study was, we need to invest like a woman. And, if we look historically, women tend to be much less confident than men about investing, but when they do invest, a lot of times they're getting a lot better results thanks to biology, maybe some psychology as well. And some of these studies kind of pointed to the fact that women outperform men in investing because they're a lot more patient. They can withhold that buy and hold strategy where maybe men get a little bit more antsy and afraid and start to sell things off. And so maybe we have to all think like you ladies and get some better returns over time.
Well, I would attribute that to wiring, and women. Because women are more short-sighted, detail-oriented, that we're going to do a little bit more due diligence up front and not take that bandwagon approach. Well, everybody else is investing, I might as well. And our ego doesn't get the best of us because of that lack of confidence. So we're going to really research, and we're going to make more of a calculated approach than to maybe like some guys throw it all at the wall and see what sticks.
I think you got a great point. There's another great book out there called Warren Buffett Invest Like a Girl and Why You Should Too. And in that book, they talk about how women tend to approach investing just like you're talking about, a little bit healthier and calmer fashion. And, where testosterone in us men, can help us take risks and make us move faster, making loads of money in the meantime. But a lot of times, we hold on to things for too long, or we take too much risk instead of taking a little bit more balanced approach.
Well, one of the things that I want to talk about after the break is some specific issues that we can use today, some questions we can ask to help identify what is our risk tolerance and how do I move forward in spite of some of my hesitations. You are listening to Tony Drake on Unlock Your Wealth Radio, and we'll be right back with more after this. Welcome back to the show, everyone. You are listening to Unlock Your Wealth Radio, and I am your purveyor of prosperity, Heather Wagenhals, and I have certified financial planner and NBC's Ask the Expert, Tony Drake, with us today. And we've been talking about risk, and you mentioned how us chicks are so much more way fabulous at that.
That's just one of the many ways, Heather.
Yes. It's so funny. I'm working with a nonprofit, and there's a bunch of these Green Berets, and they were saying that women shoot better than men too, because they don't have that testosterone, like you brought that up earlier. So when we think about risk tolerance, first, how do I appropriately identify risk for my age and my goals? Like, what are the questions I need to ask myself to tie those two things in so I can hone in on risk? Because that'll direct where my investments go, won't it?
Oh, absolutely. If you're working with a qualified professional, they should be spending some time asking you some questions. In my practice, we actually use a tool that has you go through a series of questions and assigns you with a risk score, if you will. And, those questions are going to talk about, and we're going to focus a lot about on the downside. I think a lot of people in the industry focus just on their average rates of return and the upside, which is great stuff to talk about. But, let's face it, when the market really pulled back in the end of 07, the beginning of 09, about a 15, 60-month period, talking 52% losses, it took about 37 months to break even. Your time horizon was fine. There's nothing wrong with that. You brought up some great ideas, Heather, about buying some things at a discount at that point, but you had to have the wherewithal and the tough stomach, I guess, to ride that out.
Or you just had to know that that's the time to go shopping. A lot of people just don't know. They buy into the hype, and they don't stay focused on their long-term vision because they let the mania of the moment get the best of them.
I think that's a great point. When you watch all the talking heads, there's a lot of great advice out there, but I think we have to remember that drama sells, right? The more dramatic they can be on the different programs, the more advertisements they're going to sell. So you really have to have them focus that long-term goal. Now, of course, as we get closer to that goal, whatever it might be, let's just say it's retirement. Obviously, we want to adjust that. So a lot of it's going to be about timing. I know that sounds basic to a lot of people, but If you can really understand the concept of what we're doing over time, and you can understand that when things pull back, we had a big pullback in oil at the end of last year. And, maybe I think over time that's probably going to recover. So that there presents an opportunity for a lot of folks to say, hey, can I buy some of these great value companies at a pretty big discount here because I have, 5, 10, 20, 30 years before I'm going to need this money and really take advantage of that opportunity.
No question, because, it is a finite resource. So let's do risk by the decade. So let's say I'm in my 20s. I'm trying to hope and pray that I'm going to get a job when I get out of college to pay my student loans off. Now, should I still be investing at this point? Because I listen to Unlock Your Wealth Radio, and I hear that that less money early on wins the game. I don't have to invest as much if I start early. So should I start early, and what kind of investments should I put my money in as far as risk is concerned in my 20s?
This is an opportune time in that decade to absolutely get after it. And I know it's tough for a lot of people. If you look at this generation, my heart is out to you folks. It's a tough time. This generation's coming out and having a tougher time finding jobs. The average rate of debt each year is going up and up from these student loans, and it's difficult. But for this generation, it all comes down to that budget. And if we can understand the concept of giving up a little bit now, and like you mentioned, it doesn't have to be a lot because you have that time value of money. We're just in our 20s. We're probably not going to touch it for 4 decades. So we can start to stick some away now. You really have the time on your side. And absolutely, we want to look at the riskier investment, the growth opportunities, emerging opportunities, some things that do have some high risks, but also over time we should be rewarded with some high returns.
Okay. All right. So let's say I'm the kid that partied away my 20s, and now I'm in my 30s. Maybe I got a kid on the way. Now what's my risk tolerance look like? How does it change for me?
Yeah, I think we all know those, don't we? Or maybe we played that role at one point in our lives. But certainly as we kind of buckle down, we're having the kids. I think at any generation, any decade, if you will, it's easy to come up with 100 reasons why we just don't have the money right now. And for whatever reason, as Americans, we tend to, spend now and worry about later when that comes, right? But, those are the people that I meet and come into my practice, and those are hard conversations where we have to say, there's not a whole lot we can do for you because it's just too little too late. So if we can start in our 30s, again, still plenty of time. We don't have to be really concerned about risk. We want to be looking at a growth-oriented portfolio. And yes, when those 2008s come along, you're going to get hit. But again, you're going to have some great opportunities to buy at a discount because we have time on our side.
Okay, so now I'm in my 40s. I had to find myself after I got out of school and joined the corporate America, and I didn't like that so much. So I had to find myself in my 30s. So now I'm in my 40s, and I'm thinking about investing. Maybe I haven't settled down yet. I might not be married. I might still be a bachelor or bachelorette or a cougar. Aren't they called cougars?
I think so.
So I'm in my 40s and I'm a cougar. Now what's my risk tolerance? How much has it changed? How much have I lost?
Depends on the guys out there.
Yeah, I think that's for sure. Maybe you guys can help me find one of those cougars. But, certainly a time to continue thinking about investing. And up to this point, we haven't talked about employer-sponsored plans, but at a bare minimum, we got to make sure we're putting enough money into we're at least getting that match. We don't get free money in a whole lot of places in life, and that's free money that you're giving up if you're not taking advantage of that. So really important. I'm a big fan of the Roth options, whether you have that through your employer-sponsored plan or you're doing something on your own. Biggest complaint, I work with a ton of retirees, and the biggest complaint I'm getting from these folks is these RMDs. If you're not familiar, at 70 and a half, your pre-tax accounts, you have to take out a distribution when you hit 70 and a half, and it's taxable. A lot of these people are getting hit over the head with a big tax club. So depending on your tax bracket, one might make more sense than the other. But if you're not in a tax-sensitive situation, boy, that Roth makes a whole lot of sense. And still, I know we're getting a little bit closer, but plenty of time to recover from any pullbacks. At this decade, I wouldn't be too concerned about risk either.
Yeah. Well, so after 40s, 50s and 60s, do we have a shot at things, or what's our risk at that point?
I always like to say it's never too late. I meet a lot of people that say, boy, I didn't do the things that I was taught or I should have done earlier in life. And, it's never too late, but we might have to buckle down and make some sacrifices. If we haven't put sufficient assets aside, it might be time to pass up on some of those vacations, or maybe that Mercedes you've had your eyes on, or whatever the case might be, and stick that money away. And, there's still plenty of time here. There's some great balanced portfolios, a lot of options out there that you can look at. If you're not familiar with your employee-sponsored plan, if you're not comfortable picking those choices, there's a big difference. Many of us don't have pensions anymore. I still have some of my older retirees that are coming in with those healthy pensions, and a lot of us just don't see those options anymore. One of the biggest challenges when we went to these other types of retirement accounts is not only were we responsible to make the bulk of the contributions, but we had to make our own investment choices. And historically, the retail investors don't do too well there. So don't be afraid to get some help. There's a lot of great folks out there that'll help you make those choices. And as we're getting closer here, choosing and being in the right spots from a risk perspective and from an opportunity perspective even is really important. So don't be afraid to reach out and ask for help.
That's such great advice. Tony, thank you so much for being a part of Unlock Your Wealth Radio. If folks want to find you to get some of that valued advice on how to assess their risk tolerance and move forward with their financial future, how can they get a hold of you?
We have a couple of great tools out there at our website, wealthwisconsin.com. There's a banner right at the top that says, "Does my portfolio fit me?" It can take about 5-10 minutes to answer some risk questions. We'll get in touch with you if you're willing to share your current portfolio. What we'll do is we'll input that and see if your current portfolio actually matches what your answers are on the risk questionnaire. So that's a great way to get started. We can also be reached at 414-409-7226. Of course, there's never any cost or obligation. We're happy to talk to you and at least begin a conversation about risk, and just make sure for the stage of life that you're in and the goals that you're reaching for, that you're really in a good position to accomplish those goals.
Well, thank you for being a part of Unlock Your Wealth Radio. And for those of you who are driving around without a pencil, never fear. UnlockYourWealthRadio.com is here, where you can visit Tony's show page and get his phone number and the links to his websites and so much more. Stay tuned for more Unlock Your Wealth Radio. We've got more coming up right after this.